So I think when people think about a cash flow mindset, they think originally just the metrics, right? So they think of cash versus profit. It's just different metrics, right? I think what we'll see here in a second is that it's much bigger than that. Some things are pretty obvious, but we're going to go from like top to bottom. So more obvious to sort of less obvious. So when you have a free cash flow mindset, as Larissa mentioned, you have a complete financial view. So that's why I think cash is really king in an FP&A world. It's a complete view. It's not just a P&L view. It's not just a balance sheet view. It's a complete view of your financials. It's more transparent. It's harder to manipulate. It's the complete view. On the other side, when we think about a profit and loss mindset, profit and loss is a partial financial view, right? Which in itself is not a big deal, right? It's the profit and loss. But the problem is when you try to maximize a partial financial view or a partial view, you're really maximizing what they would call in the manufacturing world a local efficiency. So what happens is you improve something only to kind of bottleneck things up later down the road. As we move down, we also think about cash. We think in terms of sources and uses of cash, so inflows and outflows of cash. Because of that, the detail is not that important. This makes it more agile. You can run scenarios, change rules, create multiple models, creates a lot more flexibility in the system. In your traditional profit and loss mindset that we all have, it tends to focus very much on account detail and detail in general, right? And the result is really a false sense of precision. On the cash flow side, you can be detailed, you can have more detail, but the need isn't there, right? It's more about the sources and uses of cash, and that kind of creates that more flexible environment. Moving down to things that are even less obvious when you have a cash flow mindset. When you have a cash flow mindset, you try to invest up front, right? So you look for bottlenecks, you look for things you can break, and you throw cash at it. You make small little investments, try to break down that bottleneck, which then creates an opportunity that you can expand on, create market share. Ultimately, you have good market share and you start to plateau a little bit on the market share. At that point, you're a cash cow, you're generating a lot of income, you're cutting back on your overhead expenses and maybe some of your CapEx. You're generating a lot of free cash flow, you're investing that back in the business, and eventually you sort of decline and sort of fade off. That's the whole life cycle approach. When you have a P&L approach, it's those rigid time frames that we all know about, right? So it's a 12-month AOP, 18-month rolling forecast, 48 to 60 months LRP. So those rigid time frames that you use for variance analysis that don't really, kind of constrict what's really going on. And the last obvious one is when you have that life cycle approach, you can take more of a portfolio approach to managing your business. So you know that your business is broken down into several different life cycles. You can manage each life cycle, each entity that exists in that life cycle. They require different matrix, different leadership styles. It's just better to keep them grouped that way rather than to do what we do in the traditional P&L mindset, which is run a consolidation. When you consolidate everything, you really sort of average everything out. So all of your opportunities kind of average into a straight line, which is kind of ironic because you're building a lot of detail account-wise, and then you're sort of consolidating out that detail and averaging it out. So when you look at the kind of life cycle or the cash flow mindset, free cash flow is more about growth, and P&L is really more of a justification story. And the conclusion I'll make a little later on, and I leave it here in the title, it's really impossible to maximize profit and value or shareholder value at the same time. You have to invest in growth opportunities, which are going to take a hit to your P&L, but later they're going to be your cash cows, and that's where the valuation comes in. So you can't really think about the two in the same way. So let me give you an example here. We're going to go to the next slide. I've just got 3 slides in total. This next slide is kind of like a playbook for cash flow. So what you'll see here on the matrix here is we've got, we've got a cash flow statement here, right? So we have cash flow from operations on the left, which is measured by low and high. So low could be negative cash flow from operations. High is obviously very positive, good cash flow from operations. And then at the bottom there, we're looking at cash flow used in investing. So we're always investing in the business. The question is, are we investing to build the balance sheet? That's growth CapEx. Or are we investing to maintain the balances, just replace the depreciation? That's more of a maintenance type CapEx. So when you do that sort of cash flow cycle, life cycle playbook, you always start in the bottom left corner, right? You're looking for opportunities to break, bottlenecks to break. You do a little seed investment into that. You get some traction. You move up into the next quadrant, which is the growth quadrant. You're generating sort of higher cash flow from operations. You're still investing in growth CapEx. You're investing more into the problem. And eventually, hopefully, you're sort of kind of reaching maximum share, market share, and you're sort of stabilizing your customer acquisition costs, which switches you over more into a plateau type mindset where you're able to manage your costs better because you're keeping your market share high. You can now reduce some of your overhead costs, and your CapEx switches more to a maintenance approach to CapEx. If you want to extend that plateau stage, right, you're thinking about like product extensions and things like that on the same asset base and so forth. And when you're generating those cash flows, it's really incredibly important that you reinvest those back into new growth opportunities. So we've all seen this landscape, but it's putting it into practice in an FP&A world, which is really hard. And that last quadrant there is just the decline, right? So now we're sort of just focusing on our existing customers, gradually trying to shrink that balance sheet because our ROI is getting worse and worse and worse. So shrink the balance sheet, get the denominator down. And then you ultimately make a decision when to go somewhere else when you're not maintaining or you're not creating an economic profit. So your return is less than your cost of capital. Then you're not creating value. So that's the typical playbook. Some of the details in there may differ by company, but that cash flow playbook is pretty much the same playbook for everyone when you think about it and put it in that perspective. So let's just conclude on one last slide. We'll kind of walk through everything in more of a visual representation. So we talked about when we have a cash flow mindset, we think about things in outlays and inflows of cash. So sources and uses of cash. Typically what happens is the outlays kind of come first and then tail off. The inflows kind of start off slow and then kind of ramp up. On average, that gives you that life cycle curve that we talk about. We look at that across different stage gates, and we recognize really important thing here is that the earlier stage gates is where the value is created, right? That's where we're creating the value, but that's not where the profit is. That's where we're creating the value. As we move to the outer stage gates, or the further ones, now we're doing the value realization. Value is growing less fast, but we're looking at things like income and ROI and so forth. When we look at that on a more portfolio perspective, we actually see that we have multiple life cycle curves going on in our business, and we need to kind of manage those in the stage gates that they're in. So that's really critical as to how you react there. And you need to realize that some of your initiatives, they're going to be on track, they're doing really well, that's great. Some are going to get delayed, there's going to be issues, you're going to have to firefight and resolve those. And some, it's just time to pull the plug on those. But it's managing that life cycle, which comes with a cash flow forecasting mindset, which is so critical.